There are people who make $30,000 a year but operate as if they have millions in the bank. They project an image of massive financial success by ensuring their lifestyle is highly visible to everyone around them. That performance requires constant funding. It means taking on aggressive monthly payments to secure luxury vehicles, designer clothing, and high-end watches. This behavior ignores a harsh mathematical reality. It requires borrowing capital from a bank at steep interest rates for the strict purpose of acquiring consumer goods that immediately and permanently lose their baseline value. You are paying a premium to a lender for the privilege of holding a depreciating asset. This socially driven perception of wealth is a mechanism of active wealth destruction. Actual wealth creation starts with a highly unglamorous task: aggressive, relentless saving. This chart tracks the initial journey to a six-figure net worth. If you contribute $13,000 a year and earn a steady 7.5% return, the balance crosses the $101,000 mark in exactly 6 years. Look closely at the data breakdown. 77% of that final balance consists purely of raw cash deposits. In the earliest stages, you lack the massive capital required for compound interest to do the heavy lifting, making the entire process feel like an immense front-loaded grind. Pushing through that friction requires a tight grip on 3 specific metrics. You have to keep your fixed expenses, like rent and car payments, below 60% of your income. You need to audit your discretionary spending halfway through every month, and you must maintain a strict minimum savings rate of 10%. Monitoring these numbers ensures you never stretch your cash flow to the breaking point. It provides the psychological stamina required to survive the grueling, savings-heavy phase of early wealth building. Once people manage to accumulate that cash, they often assume they need a hyperactive strategy to grow it. They attempt to outsmart the stock market by picking individual winners or predicting sector swings. This Venn diagram compares 2 popular Vanguard ETFs, VOO on the left and VOE on the right. Investors might buy both to spread risk, but 92.1% of VOE's companies are already inside VOO. Perceived portfolio complexity often just creates hidden redundancies. Instead of building a convoluted web of overlapping assets, an investor could simply buy a single standard S&P 500 index fund. Over the past 15 years, doing absolutely nothing but holding that one boring fund would have outperformed 92% of large, highly paid active fund managers. The financial industry actively sells complexity because it justifies their fees. Historically, ruthless mathematical simplicity is what actually captures growth. The biggest mental hurdle to executing a passive strategy is the constant, nagging fear that the market is currently overvalued and about to crash. In 2012, financial media convinced a massive portion of the public that the market was overpriced by 50%. Those who listened to the panic halted their investments and completely missed a decade of gains. This scatterplot maps out what happens when you buy into the market at different valuations, using the price-to-earnings, or PE ratio, to gauge if stocks are expensive compared to corporate profits. The x-axis represents the market's price tag, and the y-axis tracks investor returns. The red dots highlight periods where investors actively lost money over a 5-year period. Buying an expensive stock market carries real risk on a short timeline, but watch what happens as the holding period stretches. When we extend the timeline to 10, 15, and finally the 20-year mark, every single red dot vanishes. Over any rolling 2-decade period in U.S. history, stocks have virtually zero history of negative real returns. Author Morgan Housel argues that the ultimate marker of investment success isn't beating a benchmark index, it's the ability to literally forget your brokerage account password entirely. Securing a position in the top 5% of all investors does not require predicting the future. It simply requires the financial endurance to earn average returns for an above-average period of time. The mathematics of building capital are simple. Save aggressively early on, buy a broad index, and ignore it for 2 decades. The actual challenge is fighting the human impulses that attempt to sabotage that math. Everyday spending habits naturally scale up to bleed your surplus dry. A strict defensive filter against this is the buy it twice rule. If paying for a $500 console a second time makes you sweat your budget, you cannot afford the initial purchase. For macro-level decisions, like taking on a larger mortgage or switching career paths for a slight bump in base salary, you have to force a zoomed-out perspective. Evaluate if the stress of that specific path still makes sense 10 to 20 years down the line. These behavioral boundaries operate as a psychological immune system. They protect the capital your compounding wealth engine relies on, insulating it from impulsive lifestyle inflation. Then there is the external threat of social comparison. Your neighbors are operating on completely different timelines with entirely unique risk profiles. Applying their financial decisions to your own life is a mathematical liability. Actual wealth is surprisingly invisible. The individual commanding the VIP table is often drowning in debt to maintain the aesthetic, while the people possessing deep, liquid capital rarely display it in public. The book The Millionaire Next Door lays out a stark choice. If your primary goal is to become financially secure, your probability of achieving it is remarkably high. But if your motive is to make money purely to spend it on projecting the good life, you will never cross the threshold of actual security. Extreme financial freedom relies on psychological discipline rather than complex genius. It is the cumulative result of doing radically ordinary things for an extraordinary amount of time.